Good morning from London. I'm Manus Kenny with Danny Berger in New York. You're welcome to Bloomberg Brief. Let's set that agenda.
Biden vows to stay despite two critical mistakes. The president stands firm that he will remain in the race. Earnings season kicks off. Traders await numbers from big banks, including JPMorgan, Citi, and Wells Fargo, reporting before the bell. And it's Tesla delayed. Sources say the EV maker is postponing its robo-taxi event, a blow to Elon Musk's autonomous dreams. Happy Friday, Manus.
Oh, Danny, happy Friday. Just trying to decide whether I book the Ryanair flight to Berlin on Sunday and shred the trip to Ireland. Yeah, there you go. Listen, flamethrower blasted across the bond market yesterday as that low CPI came in, reinvigorating the dovish narrative. Down went the short end and the long end of the curve, but with slightly more steepeners. Now, what you've got here is the flamethrower of risk on bond markets, but prevarication on the equities. Look at the Nasdaq down. They almost inverted on themselves. The Mag 7 was down yesterday. It was tech that took the tumble, and the money flowed into the Russell. The Russell 2000 trounced the Nasdaq by over 5.8%. That was the spread and the differential. This is about the mounting narrative of rate cuts, the scale of the rate cuts, the cadence of the rate cuts. Is it time to jump into value? Is it time to jump into smaller stocks? There's the Russell this morning, as we can see, up again. Some individual names on the Mag 7 really taking a hit. Tesla, will talk more about that in a short while in terms of the delay to the robo-taxis. Will you end up with a better robo-taxi, according to Wedbush Securities? At the moment, Nasdaq on the back foot. As I say, we have a number of others stocks to keep an eye on. It is full metal jacket in the bond market, as I say there. Gouldsby and Daly will talk about that. They add the elixir of life to the rate cut narrative. And dollar yen, well, when it's shifting, why not jump in there? That is the view. You saw four big figure move in yen, strengthening. A lot of that has been undone. The Bank of Japan, I understand, has been in there price checking. Have they really? Did they make hay while the sun faded on the dollar yesterday? Is this a moment? There we go. Bank of Japan points to intervention. We'll ask Kit Juckes in just a moment. Danny.
Yeah, Manus, as is often said sometimes, the Fed has a reaction function and the market has an overreaction function, which is why I think it's significant that we did hear a change in tone from the doves. The doves have already been more bold, talking about the two-sided risk in the labor market. But the fact you have both Gouldsby and Daly coming out yesterday, Daly saying that it's likely some policy adjustment is warranted. Gouldsby saying that we said we won't move until we're convinced we're on the path to 2%. My view is that this is what the path to 2% looks like. That's at least two FOMC members, Manus, who sound ready to cut.
And they are quite significant in both in individual terms and in this building narrative. There'll be two more prints of inflation, two more jobs reports before September. The momentum moves to a 90% probability of a cut. Will it be one and done, or are there preconditions there, as Columbia Threadneedle say, for a sequence of cuts? But here's what our guests had to say on the inflation data, Danny.
The economy looks as if it's slowing. The labor market looks as if it's coming back to normal. Inflation looks as if it's coming down.
This is one of those times where, OK, the Fed is going to cut rates. We've been clamoring for cuts. Is it actually a good thing, though? And I think that's what markets are really dealing with.
I think they should go in September.
I do think they will start to cut in September.
They just need to be steady as they do this.
I still think that they'll start with 25 so as not to scare anybody.
If they rush it, it's going to actually look like they're scared about something.
If they move too quickly, the expectational set in the market could get ahead of themselves.
I still think September, December, March, June, September, December. 6 rate cuts, 1.5 years. I think that's what they should do.
Go slow, take your time. You've got a winning hand. Why would you do anything today or potentially September to destroy that winning hand?
Joining Danny and I this morning is Kit Juckes, Chief FX Strategist over at Societe Generale, writing this. The image that comes to mind is of a dam breaking. Higher for longer, sure. But once the rate starts to fall, the market will assume they do so quite quickly. Kit is with me here on the set in London. So did the dam break yesterday? Was this the fuel for a Powell full metal jacket pivot?
Well, there's certainly a big crack in it, put it that way. He's got 2 more prints before the September meeting, so you know, we're going to have a ton more information. But it was, firstly, it was a very striking CPI release because it was surprisingly soft. because the area of softness that finally fell into place was housing, which was important. And I might mention that, given that I've had big surprises on the downside in Swedish inflation, Norwegian inflation, I'm beginning to feel a pattern here in some way. So I think it is, almost certainly a crack in a dam that will represent a change in things, and one that's going to be massively welcome at the Fed, because the economy's not in a terrible place.
No.
And so if they can ease policy now, and if they can react, that the soft landing chances are better that the faster inflation comes down, right? If you have to keep rates high and really slow the economy down, and then you've got them too high for too long, that's how you get nasty recessions. So if I was Jay Powell, I'd smile my way through my coffee and my croissant this morning, or whatever he does.
Well, the entirety of the BOJ is probably also smiling this morning. I wonder who's more happy at this point, Powell or those policymakers. Manus mentioned it. We just got this line that looking at Japan's accounts, it looks like they spent $22 billion propping up the yen overnight after we already had a big reaction to the CPI. What do you make of that, of this being the point that they jump in and intervene as the data already points to a stronger yen?
It's interesting in the sense that it's clear that they're trying to be opportunistic. So, they've probably seen that the CFTC data would indicate there's a very big position out there, more of it in options than in spot, and the market is on one side of the boat. So that if you come in aggressively, you might do something. The challenge they have is that from 140 to 160, the market's had its own way. So some big money's been made by people trading dollar yen. The carry was huge. It still is huge. And they won't be easily dissuaded from a view that the interest rate differential, yield differential is still attractive. So if they want to turn the cycle around faster than nature would have it by intervening, they might have to come in and do a hunk more to win the fight. But if they do nothing, frankly, we could get another spike higher. All sorts of things could happen. We'll still end up with a stronger yen in a year's time.
You've looked at the positioning in yen. Adam Posen was with Danny and I a couple of weeks ago, and he said, look, they're going to have to do something like the Chinese had to do a number of years ago, which was over $1 trillion of intervention to really shift the dial from 160 to 140. They're throwing peanuts at the gallery here.
Yes, although they're big peanuts by historical standards. All we found out is that intervention sizes to work now from the days when it used to happen a lot. There's just a different order of magnitude, so you wonder whether it's worth the effort. Intervention in itself looks to me to only be successful if you've got the fundamentals on your side, which actually matters. B, if it's bilateral, trilateral, but not unilateral, whatever else. And C, you're willing to go in considerable size. So I think it's difficult. So I think the important piece is you can shift the timing and you can move some speculators around. But the fundamental reasons for dollar yen having gone up so far was that the Japanese kept rates so low while everybody else was raising them. And the economy has only seen a significant improvement in one industry, tourism, right? I mean, the rest really hasn't. So the lag from cheap currency to stronger economy that we kind of expect to happen in today's complicated supply chains is much messier than it used to be. And that would give me two doubts. I mean, one, how far back dollar yen goes, where is fair value? If PPP is somewhere in the 90s, I don't think we're going back there in my lifetime, but we'll see. But the Japanese economy is not getting turbocharged by having an absurdly weak currency yet. So I think that makes you sort of stop and pause and say, all right, I think as US rates do come down, if the US economy slows as well, we should get dollar yen back to 140 at some point in the next year or two. Maybe we'll get it back to 130. But how do you resolve the fact that the yen is going to remain a cheap place to go on holiday, for starters, still a cheap currency in the way that people think of valuations?
Yeah, I mean, who among us doesn't have a friend that's been to Japan in the past 2 years? I feel like I have a whole cohort of friends that have done that. And part of the reason this is complicated, going back to where we started, is the dollar's trajectory and the confusion for 2025, the fog of 2025, as I've said so many times on this program. In that, Goldman Sachs says that there's only a short window for dollar weakness right now. And then once we get to 2025, the political implications means that that's not a sure bet. What do you think about that?
It depends on your view of the economy. I mean, deep down, look, if the U.S. economy is going to have a lucky escape from any kind of recession, weak growth, and then back to more accommodative fiscal policy than the rest of us because the U.S. can, and 3% growth while the rest of us mess around at 1 or something, then the dollar's not going to go down very far. It's going to remain an expensive currency for a long time, and this will just be a correction. My caveat to that in my mind, though, is that this is the third big sort of carry rally for the dollar since I started work in the early 1980s. And the first two, that ended in 85 and 2001, both saw the dollar give back all of its gains. The whole rally was reversed by 87. There wasn't a recession. There was nothing wrong with the U.S. economy. The Fed cut rates, but the economy was fine. In both instances, in the second instance, we called it a recession for a bit, and now we're not sure it was technically a recession. So the sheer weight of the money that has gone into dollars, as they have hoovered up the world's excess savings to do good things with them, does leave room for a big position unwind that gives them a cheaper currency if inflation comes back under control. So I'm open to the idea the dollar has significant weakness to come.
Okay.
A sample of 2 in my career isn't a big enough sample to be sure, but why not? You know, it could go down quite a long way.
Hey, Kit, before we let you go, is it coming home this weekend? Can England pull it out against Spain?
I'm not going to jinx them by saying they can. I fervently hope so.
Okay.
I'm going to go root loudly. The Spanish are quite good at football, so we'll have to play well.
Yeah. I feel like that's a good emotional hedge, not like completely committing to it. Kit, thank you so much. Kit Juckes of SocGen there. Okay, let's get to some of our other top stories trending on the terminal this morning. China's trade surplus soared to an all-time high last month. A jump in exports overwhelmed an unexpected decline in imports. The figures raise the risk of greater trade tensions where Western countries have been increasing tariffs on Chinese exports like EVs.
The Bank of Japan conducted so-called rate checks with traders, fueling speculation of yen intervention. The Japanese currency was also volatile in early trading this morning, reinforcing the perception that authorities did intervene in the market again on Thursday to prop it up. Coming up in the show, Tesla snaps its losing streak after delaying its robo-taxi announcement. More on the fallout. That's next on Bloomberg.
Tesla is about to give us a lot more information about the robo-taxi opportunity. At first it was August 8th. Today they pushed it to October. And that just tells me that we're probably getting closer to this robo-taxi opportunity, not further away. He wants to show us something more, I think, awe-inspiring than we might have seen on August 8th, and he believes it's possible by October.
I love that. A later event means we're getting closer to the event. Work that one out. ARK Investment CEO Cathie Wood speaking to Bloomberg last night. A lot of Tesla bulls remaining. Wood among them, Dan Ives among them, after they postponed its planned robo-taxi unveiling to October. Joining us now is Bloomberg's Craig Trudell. Craig, I mean, to be fair to Cathie and Dan Ives, it's only a 2-month delay. But I guess the fact that it's Tesla makes us question that. So why do we care?
Well, I think what this sort of speaks to is this idea that, you know, maybe that the market had its hopes up of not only that this was going to be an event where it was only just, you know, a matter of a few weeks away, or in April, you know, it was only a few months away. I think there was also a sort of a hope that this company maybe was going to break from its past of you know, having these events, staging these events, and then taking years to put something on the roads. After all, Tesla has been talking for many years about its work on self-driving technology and its ambition to put a, you know, robo-taxi fleet out there that it would manage. So maybe in this case, you know, they would stage this event and soon thereafter have something ready. I think what our reporting speaks to is this idea that, even just this week, they're still working on the design of this thing. So whether or not it's fully baked, I think the reporting that we produced yesterday really speaks to the idea that this is not something that is just going to, quickly be ready for roads.
Brings back like a 90s hit in my head, which is, I promised you a miracle. And one of the miracles was the pillar of AI, robo-taxis. It was an evangelist kind of moment. UBS downgrades the stock this morning. They say too much too soon on the AI. Now, look, for one injury, flesh wound to Tesla, it's a boon and a swoon to the Uber and the Lyft of this world. But is that short-lived? I mean, ultimately, this robo-taxi will be delivered. But in the interim, do I make hay on the others?
Well, I think the idea, as you allude to, this was an 11-day run for this company where they added almost $260 billion worth of market cap. So did it maybe get carried away? I think it's fair to say that was a little bit much. Whether or not this is disruptive to Uber and Lyft, I think is a really interesting question, because this, after all, is something that's kind of reminiscent of what, Travis Kalanick was talking about when he was still running Uber, this idea of bringing the human driver out of the equation. Those companies really sort of abandoned that idea when they realized just how difficult an engineering task this was going to be. And so there has been this concern of whether or not Tesla would come in here, be able to do what those companies couldn't, and disrupt them. I think there's maybe some relief here that maybe that's less of a risk.
OK, well, let's keep an eye on it. Of course, that was Simple Minds that wrote I Promised You America. I'll leave that reverberating in all your heads. Craig, thank you very much. Let's turn our attention to aviation. Boeing back in the headlines again. Customers expect further delays on delivery over the next 2 years. This is on the 737 MAX airliner. Sid Phillip is with us. Sid, look, we know there are supply chain issues. We know both from Airbus and from Boeing. But again, this new set of delays, how much of a blow is this to cash flow?
It is a major blow to Boeing's cash flow because, for Boeing, you get all the cash in when you actually deliver the planes. And so for Boeing, they need to sort of deliver planes. And customers are also waiting on aircraft, and they're looking to replace fleets that are long in the tooth. And so it is a blow for Boeing. It's also a blow for the airlines because they have to wait much longer to replace aircraft or get new aircraft.
A little bit of whiplash, Sid, because didn't we just learn that Boeing had, for the month of June, its best delivery since the January incident? Square these two things for me, because that seemed to indicate a maybe brightening picture for the plane maker.
Morning, Danny. So, yeah, it is a sort of a whiplashy because on one hand, Boeing's had its best ever month in terms of deliveries in June, but then at the same time, that's on a very low base. And before the pandemic, Boeing was making like many more planes than it is now. And so ever since January, it has been slow and sort of trying to ramp up production after the sort of blowout that they had on the Alaska plane and ensuring quality and everything else. But at the same time, it is a far cry from where it was pre-pandemic. And it's also a far cry from where the company originally planned to take production as they moved along and sort of recovered from the pandemic. And it sort of speaks to the whole supply chain crisis that the industry faces, including Airbus.
All right, well, I know we're going to get Boeing earnings later this month, so maybe we can get some even more clarity. Sid, thank you so much. Bloomberg's Sid Phillips. OK, coming up, we're going to take a look at some of the headlines around the world, including a foiled Russian plot to assassinate Europe's top defense boss. Really wild story. We'll have more on that for you next.
It's Bloomberg Brief. I'm Manus Cranny in London. Danny Berger alongside me in New York. We're apart, but never far away. Time now for you front page news. This is what we've got for you. A look at what's making the headlines around the world. First up, Wall Street Journal leads with reports that Donald Trump is the cloud hanging over Ukraine's path to joining NATO. Declaration of an irreversible path to membership this week could easily be blocked. There are no guarantees on the future funding either, Danny, so that damn.
Yeah, and relatedly, the FT leads with this, Manus, first uncovered by CNN, a report on the Russian plot to assassinate Europe's top defense boss. That is the CEO at Rheinmetall, which, of course, gives a lot of weapons. It makes a lot of weapons manufacturing that's being used by Ukraine in the war. U.S. intelligence uncovered this plot, and then German authorities then foiled it. Senior NATO diplomats are claiming that the attempt was part of a wider Russian sabotage of European NATO states, of course, as NATO is meeting a clear escalation, Manus.
Yeah, and then the New York Times highlights, of course, Joe Biden increasingly isolated as the rank and file of doubters over the president's sharpness, it grows. Close allies, close aides to the president are beginning to weigh in, we understand, to persuade Biden to drop out. They believe they have to make the case to Biden that he can't win. And there needs to be an orderly process, Danny, to replace him. I mean, this was the big boy. I think I saw one phrase. This was the big boy conference. There were two pretty big mistakes that were made on Zelensky and on Kamala Harris. And the point about it is, straight afterwards, you had, again, growing voices of dissent. I just wonder, is this weekend, you know, some kind of a pivotal close to this?
Yeah, to be fair, it was the Biden team that was using the phrase big boy news conference that was originally come up with by our own Justin Sinks reporting. And look, he had those two mistakes and he quickly corrected himself. But the fact we're focusing on that shows, one, this is a campaign that will maybe be won and lost on TikTok soundbites. But two, perhaps, Manus, the damage is already done at this point, if that's what we're concentrating on, what was otherwise an hour-long and pretty robust press conference.
Yeah, it was. I mean, look, you know, he did take 11 reporter questions. It did go on for an hour. And the Labour Prime Minister was, the new Prime Minister of the UK was reasonably complimentary. We'll talk to Priya Misra next on the correlations.
From our global headquarters in New York, I'm Danny Berger alongside Manus Cranny in London. Let's set your agenda.
Biden vows to stay despite two critical mistakes. The president stands firm. He will remain in the race. Earnings season kicks off today. Traders await numbers from the big banks, JPMorgan, Citi and Wells Fargo. The results hit the tape before the bell. And Tesla delayed. Sources say the EV maker is postponing its robo-taxi event. It's a blow to Elon Musk's autonomous dreams. Danny, good morning.
Good morning, Manus. It was relief yesterday from a very good CPI report, one that had central bankers Goolsbee and Daly saying essentially we are there. The reaction was palpable in the bond market. Two-year yield drops by double digits, down by about 10 basis points. We are flat this morning. 4.51% is where we stand. Opposite reaction in equities, and it was all because of the Mag 7 helping the S&P break its 7-day winning streak. Mag 7 has its worst day since 2022, while small caps have their best day so far of the year. Small caps, you can see on the bottom of your screen, still outperforming this morning versus a flat S&P future session. Meanwhile, dollar versus the yen. It's unfortunately for the BOJ, it is yen weakness again this morning after we learned that they spent $22 billion in looking at their accounts in propping up the yen. We're at 159 despite the fact $22 billion of intervention, Manus, plus a cool CPI report. Kit Juckes from SocGen with us moments ago saying that if they want to see real movement, they're going to have to spend a bigger chunk of change.
It's a brilliant moment of where you see central banks make hay while the sun shines for them. You saw that, pressure on the dollar yesterday. In they come. Kit Juckes from SocGen says, look, it's going to take an awful lot more to get from the 160 level to the 140 level. And it's going to take a heck of a lot more intervention than what he has seen so far. And so much of the gun is loaded in terms of being long dollar to the yen and that monster carry trade. Danny.
Yeah, although he did say in a year's time the yen will be weaker, considering the trend across global central banks is to cut, save for the Bank of Japan. Now, elsewhere, Manus, we have to really dig into the reaction to the CPI report. Priya Misra, portfolio manager at JPMorgan Investment Management, writes this: stock-bond correlation should come back with the Fed in play. Owning high-quality bonds makes sense as a hedge to equities. Priya joins us now. Priya, good morning. Great to see you bright and early in the studio. And look, I know you've been advocating for quality bonds for some time, but this is a market that looks at political risk, confusion over the path of the Fed of when they're going to cut, and says the only thing I can buy right now is tech. Did yesterday change that?
I think so. I think we've been sort of, will they cut, will they not cut, how much do they cut in terms of the Fed? And until the Fed starts to cut rates, all the cash is happily sitting on the sidelines. You're earning 5.5%. Why bother extending out the curve? Well, that changes because what Chair Powell's been telling us and the Fed's been communicating, they need some more good data. Well, we had great data. We had data, other than the headline number that that was weaker than consensus. If you look under the hood, it was shelter. Shelter really has been downshifting slowly. There's inertia in that. So as the Fed gets comfortable that we're heading back down to 2%, I think people start to move out the curve. The other thing that the Fed has been telling us is risks are getting balanced. I think there's been a subtle shift in the message from the Fed that instead of the fear, and the market's getting there too, the market focus, the Fed's focus is now moving away from just inflation to growth. And what the Fed's telling us is if things start to slow down, and we're seeing some cracks, absolutely. The economy is slowing. I think we don't know whether it's slowing below trend or it's sort of staying around trend. But if things slow down, the Fed's going to come in and they're going to cut more. So I think owning high quality bonds, it's giving you income. It's given you income for a while, but it's giving you that hedging property, which it hadn't had because we were so concerned about inflation. You highlight political risk, that's absolutely out there on the horizon, but the election is still 3-4 months away. So I think until that, if things slow down, we have a big retail sales report coming up. If things are starting to slow down, we're going to price in more rate cuts. Yep. I don't think the market's overdone.
Priya, good morning. It takes me to come to London for a few days to get you into the studio at 5:30 in the morning, but it's good to see. It's good to have you on the show. 7 days ago, Danny, yourself and myself sat around the desk and we discussed bear steepening. Here we are 7 days later with a very, very important piece of evidence to promote duration. How does that play into your view on the curve now, 7 days later?
So, you would say, what does one data point do? Well, it gives the Fed confidence. It gives the market confidence. On the steepener, so I've had a lot of conviction on the steepener, whether it was bear steepener or bull steepener. I think now I have more conviction on duration itself. And here's why. As the Fed starts to cut rates, and we think we're there in September, whether it's September or November, the Fed's almost there. The curve can continue to steepen, but I would look at duration because in a soft landing scenario, the Fed cuts to, let's say, about 3%. In a hard landing, they're cutting much more. But, that's where what's priced in, 3.5 end point. I think we move away from when do they start to the totality of cuts. And in a soft landing, I would argue there's still more room for rates to fall in that belly of the curve, that 3 to 7 year sector. We do think those rates can fall in a soft landing. And here's where that hedging property we were just talking about, you get any weak data, the market's going to price in more cuts. We should price in the scenario that maybe it's a 20% chance. 20% chance that the Fed can cut much below that 3.5 is why that duration now starts to look attractive. Look at all-in yields. If you're getting 6% in high-quality spread product, you're supposed to buy it now because in the next 6 months, that opportunity is going to go away because just treasury rates are going to start to fall as we sort of embark on the easing cycle.
I really like that idea that this market's going to concentrate not on when we cut, but how much we cut, because that is a debate. There's a difference between a mid-cycle tweak and a full cutting cycle. So what difference does that mean for you in your duration allocation? You say it's attractive either way, but how much can you fully go in if it is a mid-cycle tweak versus more aggressive cuts?
Right, great point. Soft landing rate cuts are rare. They're rare, they're hard for the market to get its head around because we haven't seen it. Now, we're in a soft landing right now. I think the question is, do we continue? To your point, I think conviction on duration has to be a little less. So are we putting our entire risk on? No. Given the data right now, we might persist, we might stay in the soft landing. In that scenario, the Fed cuts to, let's say, 3%. So then how much can that 10-year fall? The 10-year then should probably be between 3.5% and 4%. We're not that far from that. So I would put less, I would put some risk on here in duration, just not max risk. If you start to see signs that the cracks that we've seen cracks in low-income consumers, small businesses, if they start to broaden out, if we start to see those job numbers, and again, I would say we don't look for negative payrolls. I think anything around 100, 150 is telling you that the unemployment rate's going to rise, well, then you add a lot more duration. So mid-cycle correction would be, I would say, 200 basis points of cuts. Recession, we're talking a lot more. That's when I think that duration, the amount of risk you can put on duration starts to increase.
Well, I just wonder how much of a canary in a coal mine was the Delta numbers yesterday talking about oversupply and finding that's the first time I've heard a major airline talk about having oversupply in the cabins. Priya, we've heard the message loud and clear. You're now building towards a duration position. We had Padraig Garvey in the seat yesterday from ING, and he said, look, if Biden steps down at any time, and let's assume Kamala Harris steps in, if Biden steps down, he sees it as being a risk-off event and a driver of money into bonds. So just stand back from the noise of the politics at the moment. Would you see that kind of conjugation. In other words, a shift in the Democratic ticket could be perceived as risk-off event for all the fiscal issues around it that may reverberate. Could you see that provoking a further leg up for duration?
So I think political risk is so hard to price in. These are binary risks. But if I go back a month, I think we were pricing in divided government. What happened in the last month was that probability of a Republican sweep increased, and I think people zeroed into to fiscal stimulus. So some of the rise in rates, particularly in the long end, has been this idea that the deficit will increase much more, that we're going to get fiscal stimulus. If that starts to go away, I think, yes, I think the knee-jerk reaction would be lower rates led by the long end, as this idea of either divided government or not as much fiscal stimulus starts to get priced in. But I will still highlight there are going to be many such opportunities. The market's shifting from one narrative. Remember, just a few months ago, we were talking on the show around, higher inflation, re-acceleration. Then there was concern around recession. I think we're seeing something very similar. So I think you're supposed to fade these extreme moves. Now, if today was end of October, I might say hold off, de-risk. But we've got plenty of time between now and the election. So I think if you get too much of the lower, I think knee-jerk, absolutely. But we'll be watching for, has damage already been done? So, but if it looks like the Democrats are gaining ground, the first move would be lower rates. But then if you get a Democratic sweep, I think rates might rise again, because then you might get more spending. So there's plenty of things that can move us. And I would say, let's try and fade some of those up until the election.
It sounds like a bifurcated bond market, traded right up until the end of October, and then review, redux, reload. Priya, thank you very much. Priya Misra of JPMorgan. Take your opportunities on this rolling bond market. Coming up on the show with Danny and I, the plot to persuade the president. Biden doubters grow in number, so do his lapses. More on the race to the White House. That's next on Bloomberg. Context matters every day from London and New York. Good morning.
Now I want to hand it over to the president of Ukraine, who has as much courage as he has determination. Ladies and gentlemen, President Putin. President Putin. He's going to beat President Putin. President Zelensky. I'm so focused on beating Putin, we got to worry about it. Anyway, Mr. President.
I'm better.
You are a hell of a lot better.
Moment on stage at the start. That was Joe Biden misspeaking last night at the NATO summit in Washington, as well as confusing Zelensky for Putin. The president, whose mental sharpness is in the global spotlight, referred to his vice president as Donald Trump rather than Kamala Harris. Still, the president vows he isn't going anywhere. He's still running for a second term. Our Brussels bureau chief, Kevin Whitelaw, joins me and Danny now. Kevin, look, it's almost like deja vu, isn't it? This was the start of the press conference. This was the moment, and there was another lapse. Does it embolden the doubters? Does it embolden the fuel that they really need to act quickly?
They certainly did nothing to douse the flames. I mean, that's clear. Even though most of the rest of his full press conference was a pretty strong performance. He had strong words. He had cogent arguments and answered questions pretty well. That moment and the moment where he called his vice president Trump, that is, that's what everyone was looking to see if it was going to happen, and indeed it did. And so it does nothing to change the overall narrative of a Democratic Party that's increasingly panicking about the risk that they'll lose not only the White House but also the House and the Senate come November if Biden stays in the race.
And it brings up the question of, could anything change it? If all we're focusing on are slip-ups, and I mean consequential slip-ups, but nonetheless small slip-ups at that. So Biden has said, he talked about this in his interview with George Stephanopoulos, saying it's the Lord Almighty that could convince me to drop out. Well, there's this report saying from the New York Times that some of his allies and some in his campaign are looking at a plot to persuade him to drop out. Is that equivalent to the Lord Almighty, Kevin?
I mean, I guess it would depend which allies and how hard they're working. I don't think we have the details of that. But I think that Biden went into this race with the same calculation he did in 2020, which was that he was the Democrat best placed to beat Donald Trump. And it's not clear that he's seen anything yet to change his mind on that, even if you're starting to see other people have those doubts. And so, his family's going to be super important in that. He does have some close aides that have been with him for years. But, those are also the people that have a fair amount of incentive for him to stay in the race. And so we don't really know what they're saying in private. We don't really know what that actual conversation is. The other risk for Democrats is the polling isn't entirely clear that replacing Biden, we don't really know how much of a boost that would get. It's a very difficult effort to try to introduce someone effectively new, even if it's the vice president, into the race right now. And so there's sort of a pretty strong unknown either way. The Democrats could simply make the call that the vote is actually Trump or not Trump, and any not Trump is about the same when it comes to the outcome. If that's what they conclude, then, I expect we'll still see him in November.
How important or how pivotal will this polling be that apparently the Democrats are doing, which is to understand where Kamala Harris ranks relative to Biden? Is that enough, you think, to shift Biden? I mean, there was a small window where he says there are other people that could beat Trump too. I mean, this I thought was quite interesting nuance. If they came back and said there's no way you can win, will that poll be a pivot enough if it comes back and sends a message to Biden?
I mean, we don't know, really. The polls have already been grim for Biden even before the debate, and the path to victory was looking rather narrow. The problem is you're coming to something that is the hardest thing for polls to measure, which is turnout. And it's going to be that question come November of how motivated people are to vote, how many of them go out. And some of them are going to be motivated to vote for or against Trump, no matter what. So then the real question is, what about the people who are on the fence? What about the people who are a little fed up with their choices? Is a Kamala Harris or another Democrat going to move the needle for them any more than Donald Trump? Polling is pretty hard to sort of nail that down, particularly when it gets to the fact that we're only looking at a handful of states where it really matters.
Yeah, I mean, polls can't exactly account for all the new information that voters will have to absorb. They're basically just asking now, tell us what you think about someone that you haven't had a lot of time to think about at this point. Kevin, we appreciate it. As always, Bloomberg's Kevin Whitelaw. Now to the earnings that we're going to get today. Shares of the biggest U.S. banks have been on a tear this year, with all but Morgan Stanley outpacing the S&P 500. JPMorgan, Citi, and Wells all report their earnings today. With us now is Bloomberg's Sonali Basak to get into this. Sonali, what are you going to be focusing on today in these earnings?
Listen, Danny, there's a lot on the line on these earnings, not only because we're halfway through the year, but because there's so much uncertainty ahead. And if you look at JPMorgan, Bank of America, Citigroup, and Wells Fargo, the question is, do Main Street businesses perform just as well in this environment? You saw this knee-jerk reaction yesterday when you saw the CPI data came out. When you saw that sharp drop in yields, you also saw the biggest U.S. banks also fall. And they recovered a lot of those losses, but it just goes to show, even if interest rates drop, the question is how much juice is there left in the consumer to keep on borrowing? You had Bank of America earlier tell investors that they think that the second quarter, so the current quarter that we're really seeing come out in the service now, really be the bottom for that net interest income, but how much can they recover is the question. And also, how much can they all keep costs in line? For JPMorgan, there is an expected fifth consecutive quarter of double-digit cost increases. And so the returns on equity, even at JPMorgan, are supposed to be, according to analyst estimates, slightly compressed compared to a year ago.
Sonali, good to see you. The green shoots of investment banking, the IPOs that were supposed to happen, the deals, the M&A deal flow has increased. The IPOs maybe not to the level that we had hoped. But the overall fee for equity and debt capital markets should be robust in the second quarter. Is that the jumping off point?
I'll steal from Erica Najarian of UBS yesterday. They are coming off a super low bar, she said. And that is the truth. You see some of the numbers that were posted a year ago when business was just stifled, and it was pretty muted. So the question is, how much can those Wall Street businesses supplement the Main Street businesses? Over on the trading desks, the volatility has certainly helped in rates, in currencies, and commodities. And you see that expectation really feed through in the expectations for, say, JPMorgan, Goldman Sachs, Morgan Stanley. But Manus, that investment banking dream, while it has increased the activity this year, it has still not added up to what most deal makers would want it to be. And given the second half has a U.S. election season in it, there are a lot of questions about how much it would pick up from here. So to your point, we've seen some IPOs, we've seen gangbusters debt issuance. That has been a big savior, but we have not seen M&A come in through the pipe like a fire hose, at least. So we have seen a rebound, and they should benefit from that.
And then the other cloud overhanging all of this is also the implementation of Basel III and some of the capital rules that come with it that banks have been pushing back against. Will we get any sort of flavor of that in the earnings impacts or where they stand in trying to convince regulators otherwise?
Absolutely. It comes up every quarter, particularly with JPMorgan. But the interesting thing about it here is it's going to matter more and more going into next week with the regional banks, given that they are going to be impacted in such an outsized way. The other thing that we haven't gotten a lot of clarity on is how these Basel III endgame rules will impact trading desks. And given what we were saying about that rebound in capital markets activity, that's where really the rubber hits the road for the Wall Street businesses that so many investors were excited about. Will JPMorgan stop lending on credit cards? Probably not, right? But there are certain trading activities here that many of the banks may have to reconsider in light of these Basel rules if those rules are not meaningfully changed.
Yeah, well, you're going to hear the clarion call from the Europeans and the Brits here, which is, you know, the playing field is differentiated. And lobbying works in Washington when it comes to capital rules. That'll be the other call that you'll hear from this side of the Atlantic. Shonali, thank you so much. Shonali Basak there, tracking the bank earnings. And, of course, more on the bank earnings a little bit later. On open interest, we have Chris Marinak of Janney Montgomery joining the team. Coming up with Danny and I, economic data to round out the week. What have we got to focus on? Well, context matters every day from a hazy London city.
Let's get you set up for your trading day on this Friday. JPMorgan, Citi, Wells Fargo all report before the opening bell. And then some economic data. U.S. PPI comes out at 8:30 a.m. Eastern. Plus UMich, that is at 10 a.m. Eastern. But of course, man, it's the most important event. 3 p.m. Eastern on Sunday. England takes on Spain in the Euros finals. I've already got the bar booked out. I am ready. I got my England kit. You won't see me on Sunday. I'll be posted up there.
You'll be held up somewhere in a bar with the burgers and the beer. It's 700 euros to get yourself from London to Berlin. Big shout out for Michael O'Leary. Don't say I don't do anything for you, Michael. Let's have a look at Tesla, down 1.77%, dropping again. Bloomberg scoop that it's delaying its robo-taxi from August to October. And what you've got there is, of course, down 8% yesterday. It comes to mind, Simple Minds. I promised you a miracle. It's not exactly being delivered on time. Boeing 737 MAX customers, you're going to have to wait for more aircraft, more delays, 2025, 2026. JPMorgan Chase, we're counting down to the numbers, Danny, ahead of the opening bell. What will the allocation for bad debt be? That's the question in my mind.
Manus, I was under the impression there were no flights left to Berlin, that you'd have to, like, basically walk to Germany
700
if you wanted to get there. I'm surprised there's even anything left.
There's a wee ticket in here. Oh no, that's going to Ireland actually, not to Berlin. And I'm not going to talk to you about the price of tickets of flights to Ireland. Extortion.
Oh man, if only it was Delta. Apparently they're discounting. Anyway, Manus, surveillance is up next. This is Bloomberg Brief.